One of the things that probably has focused most people's attention is that the bond market's not behaving terribly well right now. Yields are trending upwards. We've had the 30-year clearly break 5%, and it looks like it's going even higher. I mean, I would be pretty convinced it's going to test 6%. But effectively, what you're looking at is a very clear change in the trend in bond markets and the trend in yields. And what the chart that I've put up shows is the underlying growth rate of the US economy in nominal terms, going right back to the early 1950s. And you can see labeled on that chart, the black line is the nominal GDP growth. The gap between the orange line, which is the 10-year yield, and nominal GDP was very wide in the early 50s. And that was basically at a time when the Federal Reserve was actively doing yield curve control, and pushing yields well below nominal GDP growth. And then in 1951, there was the Treasury Fed Accord, where the Federal Reserve was allowed to plough an independent course and to set monetary policy by itself independently. And then you start to see a lot more co-movement between the bond market and NGDP, as you can see through that period. Now, where we are right now is probably at a similar point to that period in the early 1950s, just after the Treasury Fed Accord, where it looks as if the ability maybe, or maybe the willingness of the Federal Reserve to control the bond market is being reduced. And it's quite likely that yields are going to start to move a lot higher. Now, to answer your question specifically, which is this good or bad for financial markets? The point is that strong growth is good for the E, but it's not very good for the PE. And it's not very good for bond yields, and it's not very good for risk assets, because risk assets tend to price off things like nominal bond yields, which is what we're looking at here. So if you're looking at rising yields, that's likely to be a bad configuration, essentially. And as you can see from the chart, I've extrapolated to say that it looks likely that US Treasury yields are going to move a lot higher and probably catch up with that trend in nominal GDP growth. And the key point about this chart is that if you look at where we are now on growth, on NGDP growth, we're at levels of somewhere between 6 and 8% at an annualized rate. And that's really the fastest rate of growth that we've seen in nominal GDP since the first half of the 1980s. I mean, you've got to go back a long way to see this. So, we're looking at a very distinct change in regime here, where people have got to be prepared for a change in the basis of asset pricing.
And we are confronted with the fact that we are about to cross the threshold of $40 trillion of national debt. And we've got the 30-year interest rate exceeding 5.3%. And we've been able to ignore this debt forever, essentially. At what point do you think it becomes untenable with these interest rates going up so fast, as well as the debt? When does it actually become something that the average person thinks about?
Well, I think the point is that if you start to come back to this whole problem of debt, which is generally speaking a global phenomenon, this is not just the US, and the US is not in the worst position. A lot of other countries, Europe, Japan are in far worse situations. Probably China's even digging itself a bigger hole. But it's not to say the US hasn't got a problem. Everyone's got a problem. And the question is, how do we get out of that? And the issue is that a big deficit, as the US is running a 6% deficit, that's clearly helping to goose the economy and boost GDP growth. The government will always be able to sell debt. There's no question about that. There's always an appetite for government debt. The problem is at what price? And with strong growth and a lot of potential supply, you're looking at yields, I think, well above 6%. And that clearly is a constraint in terms of funding. And you just got to think about, a lot of private equity, which has clearly been done at much, much lower interest rates, and that's got to be rolled. And, the problem comes that this is becoming a constraint, not just on real economic performance, because clearly high rates matter, not just to homeowners, but, if you're financing capex in a normal way, that tends to be a constraint. It's also a factor in terms of financial markets, because debt's got to be rolled over. And that becomes a lot more difficult at higher interest rates. So these are significant constraints we've got to start thinking about. And at some stage, and I don't know where that figure is now, people used to think it was around about 5.5 to 6%. That's the tipping point where the economy could start to move back towards a slower growth period. I'm not saying recession, but it would start to be a constraint. So we're getting pretty close to these thresholds. There's no question about that. And the issue is how does the government really cope with this? How do they keep all these plates spinning? How can they fund themselves and not derail the economy? And one of the things that Scott Bessent's doing, maybe quite cleverly, in fact, is he's tearing up the rule book, so to speak, and issuing a lot of debt at the very short end. So he's basically using the bill market to fund the government deficit. Now, at the moment, bills represent about 22% of outstanding treasuries. They've been a lot higher in the past. Back 15, 20 years ago, they were up at 30%. And it's not inconceivable that he could try and get the percentage back to those levels. Now, if that happened, that would be akin to monetization, in other words, printing money. All these things have a cost, but that would, I think, undoubtedly weaken the dollar. It would cause the gold price to go up significantly, and it would certainly underpin, I think, a big rally in cryptocurrencies. So I think we've got to be alert to, first of all, the problem and how the problem is being solved. And it's going to become more of a problem for the private sector than it is for the government, because as I said, the government can always fund itself.
And you bring up that it was a much higher percentage in terms of the T-bills back 15, 20 years ago. Was that a response to the great financial crisis? Is that how they dealt with the problem back then?
Yeah, in part that's true. I mean, there was a at that stage anyway, there was sort of a preference for allowing bill issuance to be higher. It was a lot higher in the 1970s, for example, but it basically was brought down because it was deemed to be a more prudent way of funding a government to have to try and issue longer term debt to actually extend the duration or the maturity of government debt. And some countries have done that successfully. The US did it. Britain actually is in a situation where it's done that historically very successfully. Other countries historically have not been very good at that, particularly higher inflation countries. But there's always been that bias. But you're right to say that it's been high in the past. So there's no reason why it can't be high in the future. And I think that's the path of least resistance that many governments are taking. So what Scott Bessent is doing is, by raising the bill issuance, is, as I said, it's coming at a cost. It's monetization. It's forcing the Federal Reserve, if you like, to keep liquidity at the front end of the market abundant so this funding can get through. But equally, it's being copied by many countries. So you're looking at, Britain is talking about reducing the average tenor of government debt. The Japanese are doing it. Germany's talking about it. France is certainly active in doing it. So, this is not, a single event. We're looking at governments generally. And I think that's the point that, Bitcoin or crypto investors have got to start thinking about seriously, is there seems to be a recognition that the path of least resistance here is not fiscal consolidation. It's kicking the can down the road and funding that through printing money, although they're not going to call it printing money. They're just calling it funding at the short end of the market.
Yeah, I think that's the long-term thesis of Bitcoin, why many of us got into it in the first place. And it's been sort of shrouded, I guess, for the last year or two with the AI trade and all that. But at the end of the day, they're going to have to print. They're going to monetize this debt. And whether it's front-loading the short end or what have you, they're going to find ways to do it. And so let's talk about those ways. I mean, we've got Scott Bessent and we've got Kevin Warsh, and it seems as if Warsh was put in there in order to work alongside Scott Bessent and deal with this debt problem and make sure that the economy is still humming nicely, despite the fact that we're dealing with these issues here. So what do you see in the relationship between Kevin Warsh and Scott Bessent, and what tricks and tools are they going to use to keep this party going?
Well, I think the first thing to say is it's a close relationship. There's no question about that. I think you're absolutely right that Kevin Warsh was put there so he could work closely with Scott Bessent. That seems to be the case. What are they doing at the moment? They're talking a good story. So, Kevin is clearly saying that he's thinking about tightening monetary policy, but not actually doing it yet. my old boss Henry Kaufman always used to say at Salomon Brothers, if a central bank starts to talk like that, this is a central bank that doesn't want to raise interest rates, and I think that maybe is probably a pretty good takeaway. Generally speaking, what they've been doing is undertaking three things. They've been funding at the short end of the market, which is we've just been talking about. They've been trying to cap volatility in the bond market so they can keep the basis trade running and keep an orderly market. And that's really been the engine for that has really been Treasury buybacks. So the Treasury going into the market periodically, auctioning or at auctions, bidding for off the run treasuries. And that is basically not just taking duration out of the market, but really taking stale issues out of the market. And it's a little bit like saying, the analogy is, would you rather own a second-hand, car, or would you like a shiny new vehicle? And everyone prefers the shiny new vehicle. So basically, that's one way of actually keeping volatility and keeping yields low. So that's the second mechanism. And then the third mechanism is basically operating at the very short end of the market. There's a Fed operating at the short end of the market and maintaining liquidity. In other words, giving banks whatever liquidity they need. Now, there was an interesting statement a few days ago, which came out of the New York Fed, which said they were halting for a month the reserve management purchases, the RMP program, which has been brought in late last year, in December of last year, as a way of managing shortages in the repo markets. It was a liquidity boosting effect. It was actually a QE measure, although we were schooled very carefully by the Fed to say it wasn't really QE, but in fact it was. If it's yellow and quacks, it's a duck, after all. So that's what it was. They seem to be taking that punch bowl away temporarily. And a lot of commentators have said, aha, this is Kevin Warsh starting to tighten monetary policy. I don't read it that way, actually. I think that all the indications are that he's going to keep liquidity running freely at the short end of the market. One of the things to bear in mind is that the Treasury General Account, which is the Treasurer's account at the Fed, tends to be run down quite aggressively at this time of year. August in particular sees the Treasury basically give out a lot of net cash into the markets and makes the markets normally very liquid. And it means that there's actually no need for doing the RMP, which is why I think they've suspended it. But I wouldn't read anything sinister in that. In fact, if you look at the next chart, this is the thing I think to start to judge in terms of what is going on with Fed policy. And this is looking at the 2-year yield, which is shown there in orange. This is the 2-year Treasury yield. And the black line is the SOFR rate. So this is the overnight rate in the repo markets. Now, typically what you find in rates markets is that the 2-year Treasury note is an extremely good predictor of what is going to happen a few weeks later, or arguably sometimes a few months later, in repo rates and consequently in Fed funds. So the whole idea that the Fed leads the market is completely wrong. The Fed tends to follow the market as regards rates. It's the long end that determines the short end, not vice versa. Now, it's possible for the Federal Reserve to, if you like, ignore that signal for a long time by pumping liquidity into the markets. And what you can see in this chart right now is that the orange line has broken upwards through the black line, indicating that the market is starting to discount some noticeable increases in rates in coming weeks. Now, that may or may not be the case, but it can be sustained. In other words, that disequilibrium or that imbalance can be sustained, providing the Federal Reserve is prepared to pump liquidity into the front end of the market. Now, what I want to show you is this next chart, which hopefully explains a little bit better what's going on. And what I've done is to look at the course of the SOFR less 2-year Treasury spread, okay, the orange line here, in this cycle, beginning in 2024, with latest data right up to date, as of yesterday, and the black line, which is the same cycle from 2020 to 2023. Now, the reason for looking at that is that the SOFR less 2-year spread is a pretty good way of judging US monetary policy, the stance of monetary policy. Anything below that dotted line, in other words, if you're in that negative territory, is a monetary tightening. And you'll see what happened at the end of 2021 is there was a very sharp tightening, which caused that SOFR less 2-year spread to blow out to almost 300 basis points over negative spread. And that basically was maximum tightness by the Federal Reserve, which occurred around the first half of 2022. Now, through that period, Wall Street sold off, crypto sold off dramatically by 75%. I think Bitcoin was down. Wall Street was off 25%. Now, what I've put on the chart for reference, therefore, is that's the benchmark. That's the last tightening cycle. And the orange line is where we are now. And you can see that that curve the orange line began to follow the black line downwards. And now it's sort of started to veer upwards again. So it looks as if the market is beginning to adjust to the fact that it may well be the case that the Federal Reserve is deliberately slowing up on any rate hikes. And it's going to effectively square the circle by pumping liquidity into the system. Now, if that's the case, I think that requires some rethink about the opportunities in Bitcoin and crypto, and for that matter, gold. And we can come on to gold in a moment. But I think these monetary inflation hedges are certainly worth revisiting. I still think that the Fed was going to have to, hike rates at some stage. But I think this tells us where their biases really are. And the inclination here is to try and avoid rate hikes if they can, and basically to run the system hot, if you like, by funding very much at the short end.
And the funny thing is that Warsh was put in there to cut, right? That was Trump's mission for a year, find somebody that would cut rates for him. And where does he get this idea that cutting rates would be good for an economy that is running so hot, right? I mean, is it just because he's a real estate guy that's been in the game of real estate for decades that makes him think that the best thing in the world is always low interest rates?
Could be right. I mean, I think that makes a lot of sense. I think that, I would tend to take a slightly different view about why Warsh was put in. I don't think it was necessary to cut rates. I think it may have been to hold rates where they are, or certainly to slow any necessary increase. So what you're seeing, or what you were seeing in the first half of this year very clearly, was a flattening of yield curves. And ever since the last FOMC, where I think Warsh, in my view, was clearer in what his intentions were, despite the markets and a lot of commentators say this was very muddled. I didn't see it that way. I thought he was clearer in terms of his intentions. And to my mind, that was the trigger point for a steepening of yield curves, really since that last FOMC. And that's exactly what you'd expect under this sort of policy outline that I've suggested. So if you're saying, well, okay, I'm going to let the markets tighten for me, so I'm going to allow the long end of the market to sell off if necessary to reflect stronger GDP growth, but I'm going to make sure that funding occurs at the short end by providing liquidity and printing lots of money. That's a recipe for a steepening yield curve. It's also a recipe for probably stronger crypto and a recipe for stronger gold. And I think we're getting those progressively. So, that's my reading of it.
And let's talk about the bazooka. The last time we saw debt to GDP levels this high, they had yield curve control back in the 1940s, correct? Is yield curve control on the menu? Is it something they could bring back in times of drastic measures?
Well, I mean, my view would be not. No, I don't think they can. I mean, the world has changed dramatically from the 1950s. The markets are hugely, hugely bigger. And the ability of the Federal Reserve, I mean, as powerful as the Federal Reserve is, I mean, it's small fry, a drop in the bucket relative to the markets. I mean, in crises, the Federal Reserve can act, but then we know from experience it's got to double, triple, or quadruple its balance sheet size to do that. And this is not on the agenda unless there's a crisis. So I don't think one can suggest that the Federal Reserve is going to necessarily, stand in the way or dominate things ahead of a crisis. I think my view is that what they're going to do is really square the circle by effectively printing money. And I think this is a global phenomenon. And one of the things, in fact, it's well worthwhile, I think, rereading the speech that Kevin Warsh gave to the American Enterprise Institute back in 2018, because I think he was very, very clear on his views there. And he's basically, in a nutshell, says, look, QE works, but you've got to think of it as a supporting tool, not a direct sort of, if you like, first line policy. So I think my reading of this is that he's using this QE, although you might debate whether they call it QE, but effectively bill financing of the deficit. They're doing that. They're getting the private sector to do the QE in a sense, rather than the Fed, which is maybe a subtle difference. But what they're doing is just creating lots of liquidity, and everybody seems to be following the same model. Now, if you do that and you start to extrapolate, what does that really mean? Well, what it means is if the Japanese are inflating at the same rate as the US and the same rate as the Europeans, paper money cross rates don't change. They're going to be broadly similar. But the price of gold is going to go up and the price of crypto is going to go up. And that's the thing that I think we've got to start thinking about, because these are the two assets that, of course, policymakers always dish as being sort of irrelevant or, a barbarous relic or madness or whatever it may be. But actually, those are really the long-term benchmarks of value, because they both have got either directly fixed supply in the case of Bitcoin or more or less fixed supply in the case of gold.
Imagine waking up, opening your phone, and stacking free Bitcoin in under 30 seconds. That's SatsDrop from Rhino. Log in and you get 3 free drops every single day. The chip falls and pays out real Bitcoin straight into your Rhino wallet. No purchase necessary, no catch, just Bitcoin. A single drop can pay up to 10,000 sats in Bitcoin, and you get 3 of them today, tomorrow, and the day after that. Instead of doom scrolling X, stack free Bitcoin in less time than it takes to dunk on Peter Schiff. The only way to lose is by not playing. Click the link below to sign up for free and drop your first chip today. Use code BitcoinNews when you sign up for Rhino to claim your sats and grab an extra $21 in Bitcoin when you deposit your first $100 USD. SatsDrop. Free Bitcoin is just 1 drop away.